If you think about it, we talked about the volatility, the down market. It could be an opportunity. It shouldn't drive fear into you. You should see it as an opportunity. You want to flip that script and say to yourself, hey, if I've got a pile of cash that I've had sitting here for a while, the market's down 15, 20%, maybe I should invest this cash at the bottom. Maybe I should invest more or incrementally invest more as the market goes down. Because then when the market comes back up to even, hey, all that money that I invested at lower prices, remember we talked about the companies being on sale, you invested it down at lower prices. When it comes back to even, you've already made some money. And then when the market gets back to positive, you made a lot more money. Good deal. We are now right at 12:30, the time that we said we'd get started. So I am going to go ahead and get going with this. I'm sure some people will be rolling in late, and that's fine. But want to go ahead and get started, respect the time of those people that are here. And this is probably going to be a little bit shorter than most of the webinars that we normally do, as I obviously don't have anybody here with me today to be asking questions and kind of going back and forth with. So this will be a little bit shorter, and as I mentioned just a little bit ago, I am going to change up a little bit about what we're going to talk about today. The intention of today was investing 101 and going through a lot of the basics of investing and building portfolios and all of that, and we're still going to touch on a lot of that. But considering we had this thing planned in January and everything that's been going on the last few weeks, I thought it would only be right of me to start addressing some of what's going on with the markets currently, with the tariffs, with the volatility in the market, and just kind of address an outlook or a different perspective maybe on what's going on with all this volatility, and maybe hopefully open some people's eyes as to just a different perspective on the way of looking at all this. So I want to welcome everyone. I'm glad that you're all here, whether you're a client. I see quite a few in here. I see some people that I haven't seen their names before, so welcome to you as well. And whether you're a business owner or you're nearing retirement or in retirement, and you're just or just someone navigating the world of investing, there's a lot going on right now, and so I just want to address some of this for the first time, on one of these webinars. But let's just kind of address the elephant in the room. Market volatility is uncomfortable, and yet it's kind of unavoidable. It's like the flu or, a surprise visit from your in-laws or waiting at the DMV. Like, no matter how good your plan is, volatility is always going to be part of that ride, and there's nothing we can really do about it. So today I want to go through and talk about some things that are, some powerful perspectives, if you will, about volatility. I'd like to take the mystery out of volatility. I'd like to kind of replace the anxiety that some people are feeling about everything that's going on with a simple set of rules. And I want to walk through how your investment approach can shift over time, especially as you get closer to or live in retirement. For those of you that don't know, my name is Jaimin Garabedian. I am a chartered retirement planning counselor. I'm the owner of Assurance Wealth Management. And our job here is to help people build financial plans that they can feel good about, no matter what the market's doing, especially in times like this. And as always, I'm going to leave some time at the end for questions, but I will answer them throughout the presentation as well. So as you think of questions, you don't have to wait till the very end. Go ahead and put them in the chat or in the question and answer box, and I'll address them as I see them. But if I don't get to yours right away, I will get to it, as we wrap things up towards the end. First, I kind of want to take everybody back to a little story. 1940, London, World War II bombs are literally falling from the sky. There's gunshots going off everywhere. I mean, it's World War II. And there's a place called the Richmond Golf Club where men were still playing golf. Seriously. They were dodging shrapnel and ducking for cover, but continuing their rounds of golf. Sounds a little bit crazy, I know. But what they decided to do, and here's what's kind of wild, is they made their rules for an actual wartime rule of golfing during World War II. So a couple of these rules were players were asked to collect bombs and shrapnel and splinters and all of that from the grounds to prevent damage to any of the mowers. But the second one was that during gunfire or bombs, players were allowed to go take cover without penalty for ceasing play. Now, if you ask me, that's some serious commitment to your hobby. But more importantly, it tells us something that, a little profound. That in the middle of all the chaos of war, rules brought a sense of calmness to these golfers. They knew that they couldn't control the raids, they couldn't control the war, they couldn't control pretty much anything that was going on around them. But what they could control is how they responded to it. And for me, that's the same thing that goes on with investing. It's true with investing just like it is for them. Volatility is not exactly war, but we also can't control it. It's not optional. It's part of the market. How we respond to it, that's where the power kind of lays. That's where you are going to see better performance, less downside. You've got all the power in how you react. So I want to give you a couple of rules for handling market volatility. And these are the same principles that I share with my clients. So for those of you that are clients in here, these may sound familiar if we've had conversations about this in the past, but they're pretty simple rules and they help you take action when things feel uncertain. The first rule to volatility or caging a lot of this anxiety is keep saving, keep investing. Volatility doesn't mean that you need to stop. It often means it's opportunity. Think of it like buying Christmas lights in January. It's the same lights, it's the same quality, it's just half the price. So when markets are down, the companies are still great companies, but now they're on sale. And that's when a disciplined investor kind of builds their wealth, and not by timing the market perfectly, but by staying consistent and continuing to invest. And so what do you invest in times like this? I mean, that's where your basics come back into play. Do we go into bonds? Do we go in, keep investing in stocks? Do we look at our risk? Do we, look at our time horizon? All these different basics come back into play, and kind of breaking down what you should do is largely in part to what your plan is. It's everything's got to align with your plan. So there is no one size fits all for everybody, but taking a look at maybe your allocation. Are you diversified? Are you too heavy in one sector? I mean, we've seen a lot going on with the NASDAQ over the last few years that it'll skyrocket up and then it'll turn around and just tank. And so are you heavily invested in that? And figuring out, hey, where does your risk? And that kind of comes into rule number 2, which is keeping an eye on that risk. And I'm not saying to ignore everything that's going on. I mean, even the golfers took cover when the bombs were dropping, but the lesson is to be smart about it. You don't have to be scared in times of volatility. This is a time to kind of ask yourself, am I still comfortable with my allocation? Has anything changed in my life? Do I have different goals than I used to have? And sometimes small tweaks can prevent big regrets later. So what is a stock? Let's kind of back up and actually go through some of the basics. So what is a stock? A stock is basically ownership in a company. You have ownership in a company. What that means is if you're investing in good companies, you could get great returns should the company do well, but you're also taking the risk that that company doesn't do well or has these major pullbacks, and you can lose a bunch inside stocks as well. Are all stocks created equal? Absolutely not. There are small cap, mid cap, large cap. There are these mega companies like Apple and Amazon and stuff like that they aren't going to fluctuate nearly as much as maybe one of these startup tech companies. And so they all have their own risk and carry their own risk. And so figuring out where your risk lies and then investing properly with the right stocks can make a big difference in your portfolio. But you can also use bonds as a risk deterrent, if you will, or risk, preventative measures for those stocks going down. And bonds are essentially you loaning the same companies or governments money. And in return, they give you, if you're buying an individual bond, they give you your full money back at the end of the term. And during the interim, they're going to pay you out some interest. So you think of stocks as kind of the roller coaster. It can go way up, it can come way back down, and for some people it's a fun ride. And then you think of bonds as more of like a merry-go-round. You know where it's going to go. It's going to stay on track. It's very consistent, and you just get the interest payments during the time of the term. So, is one better than the other? No. Just depends on your goals. But then you also have to look at alternatives, and there's a million other investments out there. And I try to tell everybody, when it comes to investments, when it comes to products, when it comes to anything that you may put your money towards, I don't believe that there's any bad products. I don't believe that there's any bad investments. I believe each one of them is created for a purpose. And as long as you're using it for that purpose and that purpose fits your plan, there's nothing wrong with any of them. So you just need to know what your purpose is, what your goals are, what your plan looks like, and then which one of these investments or products fits you. And it may not be just one. For most everybody, it's not just one. You may have 2 or 3 or 4 or 5 different types of investments or different types of products because they all have a specific purpose and a specific job within your plan. So that's kind of the basics of the portfolio during volatility. And when you're looking at your risk, is figuring out what that combination is. And there's a million places you can go online to do your research and figure it out. Or if you don't want to, get with a professional and have them do it for you. But it is important to not just blindly invest and, hope for the best, because hoping is not a plan, okay? And then let's go to rule number 3. Let's invert your thinking a little bit. When things get rocky, the question I hear the most is what should I do? Whether that means, should I pull money out of the stock market, or should I put more into it, or should we switch to bonds, or should we, do this, or should we do that? What should I do during volatility? And I challenge you to kind of flip that on its head and ask yourself, what would I regret not doing 5 years from now? And that usually cuts through a lot of the fear and gives you a little bit more clarity. So if you're thinking of getting all out of the market because you're uncomfortable, because of volatility, well, tell me this. If the market spikes over the next 2 or 3 years and you couldn't figure out when to get back in because you kept thinking it was going to pull back, are you going to be pretty upset with yourself when you go down the road and miss this entire run-up? If so, then you probably don't want to get out of the market. But if you tell yourself, I don't mind missing a run-up as long as I don't catch any more downside, and if you're okay with that, then sure, maybe you do get out of the market. But again, it's got to align with your plan. It's got to align with your risk tolerance. And one thing I do want you to kind of keep in mind here is I was just looking up some stats earlier today on this exact topic and going through some research that Morningstar and Hartford funds did. It was a bit of an eye-opener for a lot of people, is if you think about the stock market since 1995, the 50 best days in the market were spread up like this. 50% of those days happened during bear markets. 28% of those days happened during the first 2 months of a bull market. So what that's telling us is that 78% of the best days in the market over the last 30 years were not in bull markets. They were not during the good times where the market's doing well. They were in these times of volatility, these times of anxiety and fear. So by getting out of the market, if you miss just the 10 best days in the market, your portfolio would have been 54% lower. If you miss the 30 best days in the last 30 years, your portfolio would be 83% smaller. Think about that. Timing the market typically for, I'm going to make up a number here, but if I were to say 95% of the country, I would say that's a little low. But 95% of the country, I would say that timing the market is a loser's game. You might do it right every now and then, but over the long haul, you're going to miss a lot of really good days because nobody can time the market perfectly. So that's where coming in and creating a plan, creating an investment plan that is rules-based is far more important than trying to time when to get in and when to get out. Because if you have rules in place, then no matter what happens in the market, you know exactly what you can do and when to get in, when to get out, when to make shifts, when to make adjustments, when to make tweaks, because it's all rules-based and it was done ahead of time while you were calm, while you weren't anxiety ridden, while there wasn't so much volatility. It's having the plan set ahead of time, which kind of brings us to your investment approach. So if you think about it, there are two ways that you can do your investment philosophy or your investment portfolio, and that's either you do it yourself or you hire somebody to do it for you. Okay, so really the only two options. If there's a third one, I don't know what it is. But so if you want to do it yourself, there's nothing wrong with that. If you want to sit down and do all the research, if you want to figure out all the best stocks, bonds, mutual funds, ETFs, life insurance, annuities, alternatives, whatever it is that you want to put in there, and you do all the research on all of them, and you come up with a portfolio that fits your plan perfectly, and you know the rules that you're going to put in place and all that, by all means, go for it. But I will say that most of the time that the people that do it themselves often do it because of they don't want to pay a fee, or maybe they think they're the smartest person in the room, or there's a handful of reasons that people do it, and some good reasons, some not good reasons, but to each their own. It is your money. You saved for it. You worked hard for it your whole career. So by all means, do what you want to do with it. I will say, if you're one of those people that kind of believes that you're the smartest person in the room and you can do a portfolio just as well as any advisor out there or anybody like that, I will say that you probably can do it better than a lot of advisors, because with that kind of confidence, you've usually done your research, and not all advisors are portfolio managers. They're not all good at managing portfolios and creating portfolios, so they just throw you in kind of the same 5 or 6 funds and call it a day. So could you do better than some advisors or a lot of advisors? Sure. But I think it was Jack Welch, the former CEO of GE, who said, if you're the smartest person in a room, you're in the wrong room. And what he meant by that was basically you want to surround yourself with people that are smarter than you, people that are better than you at certain areas of life, or in this case, certain areas of finance. So if you can find somebody that can do it better than you, that is smarter in the investment world than you are, because you know what? If you were an engineer your entire career, I'll bet you're 100 times better of an engineer than that financial advisor is. But if that financial advisor, this is all he's done his whole life is manage portfolios, he might be a little bit better than you at it. And there's no shame in hiring somebody else to do it. So when Jack Welch says if you're the smartest person in the room, you're in the wrong room, meaning the only way for you to improve at anything in life is to surround yourself with people that are better than you and learn from them. They're smarter, they're better, whatever it may be, learn from them, put the ego and pride to the side and grow as a person. So that's my one little tip of advice when it comes to that. But I have no problem with people doing it on your own. If you are going to go out and hire somebody to do this, again, you need to make sure that they have their investment philosophy aligned with your plan. So you need to make sure that the way that they're investing is designed for you, designed for your goals, designed for your plan, and it's not a haphazard, throw it into a handful of mutual funds and see what happens. So make sure that no matter which approach you use, the research is done and that everything aligns with your plans, and also make sure that there is a rules-based approach to what they're doing, that they are not just winging it, or that you are not just winging it, okay? So choosing the right investment approach can make all the world of a difference for you. But more often than not, again, through market volatility, your answer is usually going to be to stay the course. If you have a good investment plan in place, if you have a good portfolio in place that's all rules-based, more than likely your best opportunity is just stay the course. Rule number 4 is focusing on other financial areas of your life. So volatility and the market going crazy, that's just all about your portfolio. And it's a great time to kind of zoom out and say, what else could be improved in my life, financially or otherwise? So here's a few ideas for you to go through when, hey, maybe you don't want to be looking at your portfolio every single day because the market's swinging all over the place, and that's causing anxiety, or that's causing you to not sleep at night. And you know that you have a good plan in place, you know that you have this rules-based plan in place, so you know that you're being taken care of. let's look at some other things to get our mind off the portfolio. One of those things that people tend to put off and put off and put off is updating your estate plan. Getting your will, getting your trust, getting your powers of attorney, all that kind of stuff. Maybe it's a time to go and get that all done, okay? Stop focusing on your portfolio for now and go look at your estate plan and make sure that it's all ready to go. Or maybe it's time for you to build or replenish your emergency fund. If you think about it, we talked about the volatility, the down market. It could be an opportunity. It shouldn't drive fear into you. You should see it as an opportunity. You want to flip that script and say to yourself, hey, if I've got a pile of cash that I've had sitting here for a while, the market's down 15, 20%, maybe I should invest this cash at the bottom. Maybe I should invest more or incrementally invest more as the market goes down. Because then when the market comes back up to even, hey, all that money that I invested at lower prices, remember we talked about the companies being on sale, you invested it down at lower prices. When it comes back to even, you've already made some money. And then when the market gets back to positive, you made a lot more money. So as the market's going down, it's a great time to take some of the cash, the free cash that you have available, and maybe you go and invest that. Now, if you did that and you're now out of that cash to be invested, well, now let's come up with a strategy for rebuilding and replenishing that emergency fund. So strategically, again, month by month, how do we get money back into that emergency fund? Because that is a fund that you always do need to have. How big it needs to be, that's different for everybody. That's a case-to-case basis. But one of the things that'll help you with that is reviewing your cash flow strategy and figuring out how much money you have coming in, where it's coming in from, how much money's going out, or do you have more coming in than going out, or vice versa? You can look at, hey, at the end of the year, let's take a look at our income for the year. Do we have some areas or some room up until the next tax bracket? Maybe we take a little bit more income that we didn't need and replenish that emergency fund. Just some different ideas for you. So it's all kind of tweaking. It's making adjustments, and it's trying to keep everything aligned with your plan while also optimizing and getting the most you can out of a volatile market when it is down. Another area that you may want to look at, financial area that you may want to look at outside your portfolio is your insurance. A lot of times you can go through your property and casualty insurance, your auto, your home, and all that. And maybe it's a good time, if you haven't looked at it in a while, go check some rates. See if you can get your rates down, from where they currently are, or see if you can get some more coverage for the same rate somewhere else. You also want to look at things like life insurance. Do you have life insurance? I know that one strategy that we use with a lot of our clients is index universal life insurance. And the reason for that is because, again, in times like this, if you don't want to use, let's say, your cash reserves to invest as the market's going down, but you have an IUL policy, that thing's probably, if you've had it for a while, it's probably built up a good cash balance inside of it. Why don't you take that cash balance, go invest it in the market when the market's 15, 20% down, and then you can always, when the market comes back up and that money is now growing, you can always take that money that just grew and pay back your life insurance policy, and now you get to keep all the growth. So it's another cash bucket for you that you can now use when opportunity strikes, like down markets, to take the cash out of the life insurance, go invest it, wait for it to come back up, and then repay back your life insurance. And now you get to keep all the growth. It's an easy strategy, and it's one that works very well for a lot of people. I know that we did a webinar a little while back last year with Brian, who mentioned that he did that a couple of times. And it was something that he was able to take advantage in his life. Now, the level or the amount of money that you're able to do it with is going to vary person to person and policy to policy, just kind of depending on what your situation is. But in Brian's situation, he was able to put, $200, $300, $400 a month, I forgot what it was, something like that, in his life insurance policy. And then it built up over time. And then back in 2020, I believe it was, when the market came falling down, he took money out of that policy, went and invested in the market. Market came back up. He made a bunch of money. He paid back his life insurance policy, and now he gets a whole bunch of money from a cash deposit that he had just sitting in a life insurance policy. So it's another great way of investing and taking advantage of these opportunities. because there's more to wealth than just the stock market. And it's a perfect time to kind of sharpen your tools and look at different strategies, look at different areas of your finance. And one of those other areas, or one of the things that will allow you to do that is just, go into rule 5 here is understanding what's happening. Because at the end of the day, let's be honest, volatility often feels scarier when we don't know what's going on. And I think that's what happened quite a bit, these last few weeks, is that all these tariffs are coming through, and Trump is slapping a tariff on China or on Canada or on whoever. They're retaliating with higher tariffs, and then we're retaliating. I mean, it's just going back and forth, but people don't necessarily understand what tariffs are or what they do. And so I would urge you to go and educate yourself on that. And I know there's a lot of places out there that have been talking about tariffs lately. I know that we've got blog posts, we've got videos, we've done a bunch that we've sent out on tariffs and what they are and what they mean. If you want any of that, feel free to shoot us an email at info@assurancewm.com. Be happy to send you over any of that information to show you a little bit more about what's going on with tariffs and what they mean. But, that's why I love a quote that I saw not too long ago that, nothing in life is to be feared. It is only to be understood. And if you think about that, it's your fear kind of goes away when you understand everything that's going on. When you know what's going on and you understand why it's happening, there's nothing to really fear anymore. I kind of relate this to my kids, and my oldest son, he may have been afraid of the dark for quite a while growing up, and it's that afraid of the dark comes from not knowing what's in the darkness. If you can't see anything, that's why kids tend to be afraid of the dark, is because they don't know what's out there. Do they really believe that there's monsters in their closet or under their bed or something like that? Maybe, but if they get their little nightlight and now they can see in their room, they can see in their closet, they can see under their bed, there's nothing to fear anymore. They see that there's nothing there. So just knowing whether what's going on and what's around you will eliminate a lot of this fear. So I keep emphasizing this, to go out and educate yourself. And that's something that we do a lot with everybody that we meet, is try to urge you to go out and continue to learn about finances and different topics and different strategies, because the more you know, the less the less fear that you have when things are going bad like they are in the market right now. And it's easy to make adjustments, and it's easy to make tweaks to your plan if need be, if you know what's going on. And markets go through cycles. Some corrections are normal. Some volatility is more emotional and not economic. But when we understand the why, we fear the what a lot less. Now, for those of you that are approaching or already in retirement, your strategies tend to change as you get closer to retirement or into retirement. You're no longer in accumulation mode. You're now in income mode. So what does this mean when the market comes crashing down, which it's not doing? It's, we have a minor pullback right now. But if we had a market that was crashing down, what does that mean to you and your income? Well, it means you need to be looking at a steady cash flow. Do you have cash flow coming in from multiple different places that can withstand pullbacks in the market? And when I mean cash flow from a number of different places, do you have Social Security? Do you have a pension? It might be from annuities. It might be from life insurance. It might be from a bond portfolio. It might be from alternative investments that spit off an interest or an income to you. It could be from your investment portfolio itself. Do you have a strategic way of distributing money during this time period? And you're going to want to do all of that and make sure that you have multiple areas of cash flow. So even if the market does come down, it's not affecting your cash flow. You still have money coming in to live off of in retirement and continue your normal lifestyle throughout retirement. The second thing you want to do is to minimize taxes. Obviously, if you have a good distribution plan in place and again, rules-based, where you're pulling money from, when you're pulling money from it, how much you're pulling every year, you can create a tax plan that will keep you in the lower tax brackets, and it'll minimize the amount of taxes you're going to pay. Obviously, the less taxes you pay, the more money you keep, the more money you get to spend in retirement, the more adventures, the more memories, the more you get to spoil the kids and grandkids, whatever it may be. But goal number 2, if you will, would be to make sure that you minimize your taxes as much as possible. Because everybody wants their money to last. And what that means to you could be different. When I say everybody wants their money to last, some people really do want their money to last through retirement. They want to make sure that they don't have to go back to work. They have a pretty tight budget, and they have their income and they have their investments, and they need to make sure it all lasts till their last day. But then there's also people with plenty of money that know, hey, I'm not going to run out of money in retirement. I mean, I'm not going to have to go back to work. I've done very well for myself of lowering my liabilities and increasing my assets. And so I'm not worried about running out of income. But you still want your money to last, because most likely that money's going to go somewhere when you pass away. It's going to go to kids, grandkids, churches, charities, somebody. It's going to go to somebody that you want that money to go to. So you want it to maybe last not just through your lifetime, but maybe through theirs as well. And maybe future generations. Maybe you're trying to build a legacy of wealth down your family line. I don't know. Everybody's is a little bit different, but wanting that money to last comes with, again, a good set of rules and a good set or a good plan for both while you're alive as well as once you pass away. So we tend to like to diversify income sources, looking at high dividend strategies. We're looking at annuities. We're looking at structured withdrawals. We're looking at, again, alternative investments. I mean, there's a lot of ways of creating income, and I want to make sure that our clients are diversified in where they're getting their income from, so that, again, they don't have to have concern when the market comes down, because they know that they've still got enough income that's going to last them. We also want to optimize for tax efficiency. So these are where you're going to start looking at Roth IRAs, maybe Roth conversions in your earlier years, maybe timing your capital gains, a good distribution plan to, again, keep you pulling money from different places and staying in lower tax brackets. There's a lot of ways of kind of playing that tax game, and just knowing the strategies that are out there is a big thing, and can help you greatly as far as the taxes you pay in retirement. And then the last thing I'd urge you to do is kind of shift your focus from short term, like we have right now. We have a month here of market volatility, and people are, all up in arms about it, and the media is blowing it out of control and all this. But that's a very short term focus. You want to kind of focus on the long term, okay? You want to focus on the rest of your life. So when you're driving down, the highway, and you're driving from, let's say, or you're leaving where I'm at in the Woodlands, Texas, and you're headed down to, Tampa, Florida. Well, you're taking I-10 all the way east. And on your way there, you're going to probably hit a couple of, bumps in the road. Does that change the fact that you want to still get to Tampa and you want to get there by, tomorrow afternoon? No. All it means is that you may have to, hey, we have a roadblock ahead, or we have a, detour, or whatever it may be, and you just have to make small adjustments in your plan to still get to that end goal. So look at the long-term performance and look at the long-term plan that you have for your retirement, and don't focus so much on what's going on in a couple of weeks period of time, okay? It's not that big a deal. It's not going to end or blow up your entire retirement plan in 2 weeks. At least it won't if you have a good plan in place, and you, again, are rules-based and everything to help you stay calm. So in retirement, peace of mind matters. And it matters to me more than chasing every percentage point, okay? Making sure that you can sleep at night, making sure that you know that you've got enough income coming in is far more important than, I missed out on that 1% or 2% that I could have had this year, okay? You want to have the plan that's going to make sure that you can sleep at night and you don't have to worry about the ups and downs of the market, because you're not chasing every uptick, and you need every uptick so that you can survive, okay? That's not a plan. That's hope, and hoping's not a plan. And I know many of you are thinking about, kind of your own finances, but you also may want to help your kids or grandkids and help them get a strong start in life. And that's a beautiful idea, because you're not just building wealth, you're building wisdom, you're building a legacy. And so this is where I think one of the best things that you can do, and one of the things that we're pushing with our kids, we're pushing with our clients' children, is education. And educating the next generation. And so some practical tools that you can use for this kind of stuff is, Roth IRAs for teens that have earned income. If you own a business, hiring your kids and maybe using some of that income to fund a Roth IRA for them, and let them have a budget every month for the rest of the money so that they can now go out and buy their own things, and giving them $20 to go to the mall, well, today probably won't buy much of anything, but when they run out and they come back asking for more money, no, you need to learn to budget. You need to learn this is your income for the day. Spend it wisely. You may also want to look at custodial investment accounts. And so these are things that you can kind of run and be in charge of, but they're for the benefit of your kids or grandkids down the road. And so one thing that we do with our kids is I've got them investment accounts, and I take a little chunk of the money, a little piece of the pie, and I say to them, okay, what stocks do you guys want to invest in? And of course, my sons wants, video game stuff because he loves video games. So investing in, Nintendo, or he knew who NVIDIA was because of, the chips and the graphic card that they put in the computers for gaming and all that. So let them have some fun with it. It'll teach them a little bit about the market. It'll have them interested in it, and maybe they'll start learning more and more and have a better idea of what the stock market is and how it performs. You also want to teach them budgeting and the value of compound interest. I think we've all, heard that compound interest is one of the strongest things out there when it comes to investing, and just how it works and how they can take advantage of it and how they can use it to build some wealth in their life and help them get a strong start. And that's kind of how you change a family tree, right? It's, whether you started with a little or a lot, passing on the education to your kids and to your grandkids and so on and so forth, that'll get your family line more and more educated on finances and help them grow their wealth. Now, if you're in retirement, you've probably got older kids that have got jobs and maybe kids of their own, and you don't know how to approach this topic with them or the grandkids. Well, put it on somebody else. If you've got a financial advisor, I know that we're more than happy to talk to any of our clients, kids and grandkids, and help explain a lot of this to them. Get them in front of some of these. Most of these kids are in front of YouTube all day anyway. Might as well get them looking at some financial education videos. It might not be the most fun thing in the world for them at first, but when you teach them about money and then you give them some sort of reward, or they get to see the financial reward of it, it just grows and grows that passion for learning more. And you don't have to be the financial expert to raise financially wise kids. You just need to, model the clarity and confidence that you have in your finances and let them know how you got to where you are and how they can be better. I know anybody that's got kids typically wants their kids to be smarter and better and do better than they did. Well, you got to give them that education to get kind of jump started rather than just, again, hoping that it's going to happen. It's just like anything else. You put a plan in place and it'll grow. So let's kind of bring this all back to our wartime golfers here. The world was in chaos. They kept playing. Not because they were naive, but because they had rules to kind of guide them, right? And that's my invitation to everyone out there. That's my invitation to you, is if you have rules in place, follow them. Don't be afraid. Just follow your rules, follow your plan, and everything will be all right. If you don't have a plan in place, if you don't have a rules-based plan in place, either put one together, do your research, get your education on it, or find somebody that can help you do it, okay? Don't let fear drive your decisions. Let your plan drive your decisions. If you're a client of ours, thank you for your trust. Keep leaning on us. We got you. If we haven't met yet, let's fix that. I'd love to help anybody out there build a plan that doesn't have one, or maybe they just want a second opinion on what their plan currently is. Let us help you with that. Let you, go out and enjoy your life and sleep better at night and leave your legacy, one that you can be proud of. But, get some help, whether it's from us or somebody else, but get some help. We'd be happy to help you with it. No pressure. There's just a conversation to be had there. And, there should be a link here somewhere in polls, I think, that you can click on and schedule a 15-minute phone call to just have a conversation. Again, I appreciate everybody coming. I'm now going to open this up the last 15 minutes or so to questions, Q&A, anything that you guys have got for me. I'd be happy to go through. I know that we're 45 minutes in. Some of you may have stuff that you got going on the rest of the day, and by all means, if you got to run, I get it. But if you have any questions, start firing them at me and I'll answer the best I can. Let's see here. Great information. I love the key principles and the ideas around educating kids. Out of curiosity, given the current market volatility and interest rate environment, what are some of the most effective, conservative, or income-generating strategies you recommend for someone prioritizing capital preservation while still aiming for modest growth? Okay, so if you're looking, again, market volatility is a little wild, and if you're looking for something that's a little bit safer, that will still either generate income or maybe will generate some growth. Remember, with almost anything out there, there's a risk reward, right? There's a little give and take there. So you can't get necessarily most of the time. I'm not going to say always because there's always somebody that's going to show me something that you can do, but you can't get no risk investments and get fantastic returns to the upside like the S&P 500 or the stock market or whatever. So if you're just looking for low risk, low reward type investments to stay steady and protect your wealth, I would say there's four main places that you can look at. Okay. Number one is bonds. Everybody knows what bonds are. And the only risk with bonds is that with the Fed not lowering rates, meaning they're going to either keep rates where they're at or they're going to raise interest rates. Well, with bonds, bond values go down as interest rates go up. So if you're going to get into bond funds, that could be a problem there. But bonds typically don't fluctuate nearly as much as stocks or some of these other investments. So it's a safer, more modest approach, and it's a slower growth approach. So that's number one. Number two is annuities. Depending on the type of annuity that you're in, fixed annuities obviously are just what they sound like. You have a fixed interest rate. You get into them, can't lose principal, but they have a very low interest rate that's attached to them. Indexed annuities, similar, except they're tied to an index. You're not going to get full growth of the index. They're probably going to have a cap or participation rate. And what that means is if the S&P, if it's tied to the S&P 500, S&P goes up 15, 20%, you may get 5, 6, 7% of that. But you also, they said that you can't lose to the downside. When the market's down, you get zero. So zero is your friend there. But it's the second way of getting modest returns with eliminating most of the risk. The third way would be the IUL policies that we talked about earlier, those index universal life insurance policies. When you get into one of those, again, kind of zero is your friend there. When the market's going down, they won't lose anything. When the market goes up, you will get modest upside value to those inside your cash bucket of the life insurance policy. And then the fourth one would be there's alternative investments out there that can do it. So it just kind of depends on what you're looking for, what your risk tolerance is, how it fits into your plan. But there's a number of alternative investments that can do that as well. It's just finding which of those four different areas fit you. I don't think any of them are good or bad. I think they are all designed for a purpose, like I talked about earlier. I think they all have specific cases that they should be used in. I know that we use all four of them. So it just depends on the person and your plan. I hope that answered your question. Capital preservation and still getting income, that's a tough one. Everybody wants it, right? Nobody wants to lose money, but everybody wants to make money. So that can be tough, but it is possible, and with the right plan and with the right tools. Kind of the one thing I will say to a lot of people is please don't ever disregard certain investments because of an article that you read or because of a talking head on TV. Do your own research. There's good and bad to all investments. You've just got to find what fits you. All right, next one. I currently have an advisor I work with and value, but I'm also interested in having a conversation with you to get perspective. If we were to explore working together, would you see your role as complementing what she already does or potentially replacing her? That's completely up to you. I'd be more than happy to have a conversation with you if you want to just kind of get a second opinion to what you're doing. Now, I have had people come in here with advisors that we went through their plan, and it was a solid plan, and I'll let them know that. I'll say that, look, our investment strategy might be a little different. Our planning methods might be a little different. The way that we do retirement planning might be a little different. But the plan that they had was solid. It was a good plan. It's now coming down to, one of the main things that you need to look at when looking at an advisor is personality, how you guys get along. This is somebody that you're going to want to work with hopefully the rest of your life. So making sure that they have a good working relationship with you, that you guys get along, making sure that they have good communication and they're going to communicate with you and educate you on a regular basis. If it's one of those situations where you're just meeting with your advisor once a year and that's okay with you, then okay. That's not something that we do. We typically are constant communication with our clients and meet with them as much as they'd like. In a lot of situations, because a lot of what we do is virtual anyway, so it's easy to jump on a Zoom real quick and do that. But as far as being complementary or replacing, that's completely up to you. I'm going to give you the good, the bad, and the ugly of your plan. I'm going to tell you what we would do differently, how we would do it a little differently. But at the end of the day, I am not going to push you to make any sort of decision that you're uncomfortable with. That's it. I mean, you come in and we'll have just a conversation, and where that leads from there is completely up to you. Working on other financial areas. Okay, so when you're looking at other financial areas during this time period, I mean, getting your mind off of the stock market and the fluctuation that's going on within the stock market. So there are other areas of your life that deal with your finances and deal with money that maybe you should now focus on those so that you're not spending so much time focusing on, your stocks or your portfolio or whatever it may be. And again, I'm not saying ignore what's going on in the market, but if you've got a good portfolio and a good plan in place and you know that, hey, you're going to let it play out because your plan says that you're fine, your rules say that there's no need to make any changes yet, then don't give yourself the headache of watching the news every day and watching the market go up and down. Look at things like your insurance, whether that be your homeowners, your auto, and getting better rates, whether that be your life insurance, seeing if you have enough, getting a life insurance review to make sure that you've got enough to cover any sort of emergencies. You want to look at just all the different areas, your estate planning, all of that, the different areas of your life that deal with your finances, but maybe not deal with the stock market itself. Okay, so somebody asked it, I mentioned that I do retirement planning differently. What do I mean by differently? Well, it's just a different outlook. Let's put it that way. So a lot of advisors, and I used to be this way as well, when I first started, is that they give you a Monte Carlo simulation and tell you you've got a X% chance of success in retirement. The reason that I didn't like that success, 85% chance of success also means a 15% chance of failure. And I don't want anybody to fail in retirement. So what we do is we kind of reverse engineer the numbers, and instead of putting a plan in place, day one and then keeping that plan forever and expecting everything to stay status quo forever, just isn't realistic. So we like to look at things, whether we're meeting with you or not. On the back end, we are looking at things on a monthly basis to make sure that you are still on track, that you are still, on the right path towards meeting all of your goals. And we just reverse engineer all the numbers. If you need X amount to live off of, we create that income. If you have X amount for a specific goal in 5 years or 10 years or 15 or whatever it may be, we're just reverse engineering everything to make sure that we keep you on that path, and then we monitor it on a month-to-month basis to make sure that you stay on that path the entire time. So it's looking backwards. So it's looking at your goals first and your spending and everything that you're going to need, and we look backwards to figure out how do we create all that now and then make the little tweaks and adjustments along the way versus, hey, you've got this income, you've got these expenses. Now we're going to build you a plan. You have 86% chance of success. You're good. Well, everything will be fine. And that's just not realistic to me because things change in life. Tax brackets or the taxes change all the time. Every president that we get, it seems like the tax changes. Your health is going to change, your income's going to change, inflation's going to change your expenses. There's a lot that changes over time. So we believe that just making sure that you're updating it frequently to stay on track. Alrighty, I think that was the last one. Again, I want to thank everybody for coming today. We will be, continuing to do these every month. If If you've got any suggestions or anything that you would like to hear more about, please let us know. We'd be happy to make a video on it or meet you and talk to you about it, whatever questions you may have. My goal is always just continuing everyone's financial education. I want to make sure to get as much out there as possible to educate as many people as possible. So whatever topics you want to hear about, please let us know, and we'll be glad to address those either personally with you or via webinar or video. But it doesn't look like anything else is coming in. Again, thank you guys for coming. If you have any questions, please feel free to reach out to us. Other than that, we're all in this ride together on this this volatility. But don't let it scare you. Don't let it freak you out. Just know that if you have a good plan in place, everything will be just fine. If you're questioning that plan at all or questioning your portfolio at all, get some help. Find somebody to talk to about it, whether you hire an advisor or you just go do the research on your own. Educate yourself and get some help. Thanks. Have a great day.